So you're able to diversify by taking on more positions. Now, you may not, mentally or be at the level trading wise where you feel comfortable taking on 10 or 12 positions. But you can do that if you're using options rather than the underlying. Okay. Let me just kind of recap here. We're going to use options on ETFs to provide maximum exposure to price action. It's going to allow us to take profits off the table and still remain fully invested. It's going to provide us with a durable stop that's not subject to slippage. You're going to increase your return on investment, and it works for both the conservative and the aggressive investor. Big point, of course, is choosing the proper option. You're going to choose that 30 to 60 day range for the option. We're going to choose the strike that's equal to your stop. And again, that is a guideline. It doesn't mean that is definitely the one, but that's your guideline. You want to find the option that has the 75 to 85 delta range. Okay, for a lot of times stock replacement strategies, you're going to shoot for a higher delta. For trend following, if you're right, these options are going to be in the 90 delta range soon enough. So that'll fulfill that. Again, so 30 to 60 days, 75 to 85 deltas, and the strike that equals your stop as your guideline to start where you're going to start looking in the options chain to get that trade on with the proper risk and exposure. Okay, folks, I really enjoyed doing this, and I am open now for any questions that you may have. I tried to answer as many as we could as we went through. Do you have any questions? Bring them on. Let's talk some. If we are having a mean reversion type market, wouldn't the options have a high probability of expiring without a considerable profit? Yes. However, in the mean reversion market, right, we're still going to be using our stops. So, and the stops are stock-based, or ETF-based, I should say, right? So yes, you may make a little less, but the idea is that you're willing to sacrifice a little profit if the option stays in one place in order to better your risk management and improve your return on investment. Okay. When would a rollover be triggered? Okay, whoa. Chalmers, would you do the same for 30 to 60 days for currency ETFs? Yes, I think this is a broad statement. You can use this strategy on nearly any option product. I couldn't think of an option where this wouldn't work. John, sorry we're a little over your head. Investing is a lifelong educational process. I find I learn something new or find a way to look at something different every day. When would the rollover be triggered? The rollover is triggered for a situation where you have the stock or the option trading at nearly 100 deltas. So you can kind of start keeping an eye on it once it breaks the 90 delta mark. And you're probably going to consider it definitely when it hits the 95 delta mark. So that's when you're going to opt for the roll. Usually, depending on how rapidly the trend goes, you might be doing it 3 days later. If you bought a put option on the SLX and instead of having to wait 4 weeks for that drop from 100 to 95, it happened in 3 days, well, then you might stay within the same month. You might roll the July 116s down to the July 104s because you still have that criteria of 30 to 60 days. All right, I need to back up a little bit here, make sure I got all the questions. How do I get my brokerage to give me freedom to use options? All they want to give me is the ability to write call options. Everything else needs a higher level of experience. But without experience, how do I prove? Okay, how do you prove to them that you can take the risk? By putting up lots of money, Bruce. No, but seriously, there are usually several levels of option trading available to brokers. There's usually the base level one where you can sell calls against long positions and buy puts or buy puts against those positions. They usually also have a buy only single option level. So you're not going to be involved in spreads. You're just going to be buying options. And that's all you really need for this. That's kind of a median ground. And then you have full clearance where you can buy and sell in spreads, sell naked puts. But they really should have a couple of different levels, Bruce. I can't imagine that they wouldn't allow you to simply buy options. But again, you have to. That depends on your broker. Maybe you need to shop around and see if you can find a more flexible broker. Sylvie asks, are you using some other technical indicator for faster movement than PNF and SA signals for such short expiring options? No. This is just matching the strategy to what information is being provided by the point and figure analysis. If the stock stays in one place, you will lose a little money, right? If you shorted the SLW or SLX rather at 105.84 and it didn't move for 2 months, meaning that you were not in a position to roll and you weren't in a position to close down because your stop was triggered, you're going to lose a little money because it's sat there in one place. But again, that's a decision that you make based on trying to follow the trend and gaining more control of your risk and in trying to increase your return on investment. I hope that answers your question. You can't sell cold calls. Okay. When do you place an order for a long put, or do we place it in the money or out of the money? Not sure I understand your question, Peter. When we place an order for a long put, do we place it in the money or out of the money? Oh, I'm sorry. Now I understand. Stock replacement strategies, whether on the long side by buying calls or on the short side by buying puts, always use deep in the money options, right? That's 75 to 80 delta options indicates that we are deep in the money. David asks, Ed, would you use vertical spreads to reduce risk? That is certainly a possibility, David, especially if you're the aggressive trader that trades on the contra trend signals. You can certainly help reduce your risk by using vertical spreads. You are, of course, reducing your potential profit, but again, you have to constantly make a trade-off between the risks that you're assuming and the rewards that you can reasonably expect to gain. Is there any way to use the stop on the option price to limit the risk without getting stopped out prematurely? Robert asked, is there any way to use a stop on the option price to limit risk without getting stopped out prematurely? The reason that I don't like using stops on options, Robert, in terms of actual physically submitting a stop to my broker, is because too many things can change. I might be near the strike in a situation, but not in a position where my stop would be triggered, but for whatever reason, volatility has come down. So I don't want to be out of the trade yet, but if I've chosen a stop in the option price, when the stock or the ETF gets close to the option price, it may be triggered accidentally, and that actually would cause you to be stopped out prematurely. So really, you need to be able to effectively use mental stops when you're trading options, and you have to be true to the discipline. I hope that answers your question, Robert. Ron asks, ETFs generally seem to be long positions. I assume you mean long term. Options in the 30 to 60 days are short term positions. It seems high volatility in the sector is necessary for the options to move in 30 to 60 days. Yes and no, okay? It is a short-term position, relatively speaking. However, because of the level of delta that you are assuming, you are going to be able to capture the smaller moves. In other words, if you bought a low delta option that was out of the money and the ETF did not move much, you're just going to lose that premium. With the higher delta option, you are going to gain exposure to those smaller moves. I feel that a 30-60 day range is a good one. Obviously, there are other opinions. If you are more comfortable using the longer dated options, the Novembers and Decembers, then that is a judgment that you make from a risk perspective. You need to be comfortable with the trades that you're making because they are going to make you money or lose you money, and you have to know what you're comfortable with. My opinion is that 30 to 60 day range is going to be sufficient in most cases, to accomplish what you want to accomplish and to get the gains that you're looking for. I hope that answers that question for you. Ann asks, what is more important, the stop, strike equals stop, or 75 to 85 delta? 75 to 85 delta is much more important, okay? Like I said, the strike equals your stop, that's kind of a place to start. In a lot of cases, it'll meet the other criteria. That'll be a 75 to 85 delta. But if volatility is a little higher, then you might have to move up or down a strike, depending on whether it's a call or put and whether you're going long or short. But so the strike as your stop is hopefully it'll work out, but you might have to adjust it by a strike. The important thing to remember is that your stop, which is ETF-based or stock-based, doesn't change regardless of which strike you use. I hope that answers that question. Sylvia was already on top of that one. Is the option best for selling and also 10% buys over 30% buys? Are you talking about the sector signals? If you're in a position, Sylvia, to take an opinion on an ETF, in other words, you're going to make the directional bet, as long as you have that liquidity, as long as you can find these specifications, there's a good chance that your option position is going to be a better choice than your underlying position. Again, there are options on illiquid stocks and illiquid ETFs that are going to be much too wide, and this strategy won't be appropriate. Mel says, when you say you can lock in profit, is it because you roll out of the near-term option or because you have rolled up to a higher, further out option? I'm locking in profits because what I'm doing is I'm taking that money that I made on that first initial option trade and I am selling it out. I'm taking that profit. I'm going to invest something in the next option I buy, but I can't lose now any more than that new option price that I paid. So I've taken some of those profits off the table without limiting my exposure to the directional movement that I'm trying to capture. If you can roll in a long-term trend multiple times, you're taking that money off the table without closing out your position, and that's one of the key advantages here. Okay, I hope that answers your question, Mel. Chalmers, have a great weekend. Thank you for stopping by. All right, just scrolling through some questions here. Trying to catch up. There was a lot of conversation going on as I looked at the question. I find the evaluation at the end of the trading these options. Find evaluation at end of day trading these options is as important as adjusting stocks. Yes. Sylvia notes that evaluation at the end of day trading. My chat just disappeared. Mark, classroom assistant, anyone? Oh, there it is. Okay. No, wait a second. Excuse me while I have little technical difficulties here. You know, imagine me humming a little tune for the technical difficulties thing. All right. Yeah, but I would agree with you that you got to evaluate and you got to move your stops, your mental stops at a minimum. All right, I think I'm catching up to where it actually is here. Okay. Werner asks, when trading ETFs, is it mostly with options? That's, again, Werner, it's going to depend on the liquidity and your comfortability with option trading. You know, again, you know, just like short selling, I think puts are a much better way to short sell or to get short a market or an ETF, but you, A, have to be comfortable with it, and B, your broker has to let you do it. Okay. Well, you're welcome, Leslie. I finally got it caught up to that one. Thank you, Tom. Yeah, Sylvia makes a great point. You know, any kind of investment, you know, chances are you're not going to get it the first time around. You need to study it. You know, you have to educate yourself. This is what it's all about. This is what Tycoon is all about, is providing you with a means to improve your education and become better investors. And it's there so that you can review and really get it ingrained in your head. Can we take Sector Hunter options alerts and paper trade them in EMP? John, that's a good question. I will check in with Teak and Chris and make sure that's all kosher, and I will definitely take a look at that. It's a good idea. Oh, EMP. There you go. Mark just answered this question. Elite Mentoring Program. John, when we go through, if you're not familiar with options, or you're kind of new, or you feel like you want to polish up, we highly recommend that you go through the Options GPS program, which leads to the Elite Mentoring Program, so that you can begin taking some of your ideas and applying them in a real environment and understanding. And we paper trade mostly, but we paper trade to continue the education that we learned in Options GPS. We have a real solid course that helps you understand all the ins and outs of options, trading in the options markets. And once we have that basic knowledge done, then we paper trade. This is exactly how we did it on the floor. We spent hours and hours covering the basics, and then we would do it with simulated positions. Would using a vertical spread with a small spread, say 2 or 3 points, work using your parameters 2 to 3 months out? You know, Robert, that is a difficult question to answer right off the bat, because of the fact that, you know, if you're taking a spread, we know that the maximum value of any spread is going to be whatever the difference is between the strikes. So as you head out on the calendar, it's not going to change that much. You're still going to have roughly the same parameters. You know, the August, or well, the September, you know, $3 spread is not going to be terribly different price than the October $3 spread. So that, and verticals are really not something that we're talking about today, but I appreciate your interest, like I said, and I can't say that I would use these parameters necessary for a vertical spread. Okay, this is strictly a stock replacement strategy. It seems that Scott says, it seems that in times of very high volatility, which we have seen a few times in the last year and a half, that put options at least lose much of their utility because the premiums are so high. The folks making money are the option sellers in that case. Scott, that is true when you're talking about the at-the-money options. When you move deeper into the money, volatility has less and less effect on both the value and the delta of the option, meaning that it has less effect on your exposure. Okay? Volatility and time premiums go hand in hand, and this is getting a little beyond what this is about, and that's something we do cover in GPS, but it's about finding the option with a minimal amount of extrinsic value, the one that gives you the most exposure to the actual price movement. You know, when you're in a high volatility situation, it may be time for a vertical. But you need to understand the Greeks before you can make that decision fully and what your risk exposures are. Yeah, exactly. Because premiums, does your high delta criterion filter out overpriced options? In other words, too high premium? Yes, that's exactly the point. Because, you know, when you're at the money, you have the highest level of extrinsic or time value. As you move deeper into the money, that becomes smaller and smaller. You're welcome, Mark. Have a great day. So yes, the higher delta is the whole purpose of this is to use that higher delta. All right, folks. Why do you call it stock replacement if you don't own stock? Well, because I'm replacing my stock position or potential stock position, Jack, with an option, which is going to act a lot like stock because it's got that high delta. I'm going to be able to capture those smaller moves. So I'm replacing the potential stock or ETF position with an option position. You're welcome, Carla. I'll see you, I guess, on Wednesday. Right? Next Wednesday? Next Wednesday. There you go. Warner answers the same way. All right, folks. I really enjoyed this. I hope that you guys, even the experienced option traders, maybe got a little bit of new information to think about it. I know there's a lot of information. You're going to be able to review this once it gets posted. Again, I really enjoyed it, and happy trading. Thanks again. I am out of here.